Welcome to the Explainer. Okay, let's just dive right in. Right now, we are looking at a market environment that feels, well, almost unstoppable. We are seeing record market highs day after day, driven primarily by the sheer force of artificial intelligence. But here's the core tension we're going to unpack today. Is this incredible AI momentum actually masking an underlying structural fragility in our economy? As we go through this, we're going to separate the wealth effect illusion from the actual macroeconomic reality.
So here is the question that should literally be keeping every focused learner and investor up at night. How is a market dominated entirely by a single theme, simply ignoring the warning signs flashing right beneath the surface? Today, we are going on a journey of illusion versus reality. We're going to look directly at the data, break down the structural advantages hiding in plain sight, and see exactly what happens when market euphoria meets hard data.
All right, Part 1, the AI market monolith.
First, we really need to understand the undeniable facade of the current environment, which is the absolute total dominance of the technology sector. The market simply can't quit tech. Look at these numbers. The PHLX Semiconductor Sector Index is up 5%, completely outperforming the broader indices. But the catalyst cards at the bottom are what tell the real story. Intel spiked 11% just on reports that Google and Nvidia might consider it as a backup chip-making option. Meanwhile, Marvell Technology surged 9% simply because it was announced they'd be included in the S&P 500. So the crucial takeaway here is how investors are actually behaving. They're treating any weakness in tech as a quick reset for crowded trades, definitely not a broader risk-off move. The mentality is totally clear. As long as tech earnings head higher, the stocks will follow.
Now, I want you to take a second and look at this number, 40%. Ask yourself, in the context of the S&P 500, what does that massive number actually represent?
Well, here is the punchline, and it's all about historical contrast. Look at the 1965 portfolio on the left. Back then, you hit that 40% threshold with incredible diversity across 7 distinct sectors. You had oil with Exxon and Texaco, chemicals with DuPont, consumer goods with Kodak, autos with GM, retail with Sears, telecom with AT&T, and tech with IBM. Fast forward to the 2026 projected portfolio on the right. That exact same 40% concentration is now entirely monolithic. Every single top 10 stock, Alphabet, Apple, Nvidia, Meta, Broadcom, Microsoft, Amazon, Tesla, Micron, is completely tethered to one single theme, artificial intelligence. We have literally traded a diversified foundation for a massive, single-pillar monolith.
Which brings us to Part 2, the consumer wealth illusion.
This leads to a massive knowledge gap in our day-to-day lives. We all know inflation is stubborn, right? May's CPI is expected at a very sticky 4.2% year-over-year, with core inflation at 2.9%. Producer prices are expected to run at an annualized 6.4%. So, if things are so wildly expensive, why on earth is consumer spending still remarkably high? The answer is the wealth effect cycle. The AI tech boom, driven by giants like Nvidia, is creating this multi-decade surge in equity values, and that leads to massive household portfolio gains for the Americans actually holding these assets. Those wealthy Americans are then taking those stock gains and splurging, which completely sustains consumer spending and masks the pain of inflation. That spending then drives corporate earnings growth, which feeds right back into the tech boom. Wall Street is just shrugging off any signs of everyday consumer distress because this upper-tier spending is totally covering it up. So what you should really take away from this is that Nvidia isn't just powering data centers anymore, it is literally powering U.S. consumer spending.
Let's move on to Part 3, the mega IPO pipeline. Guys, we are currently witnessing a staggering 11-figure fundraising frenzy. SpaceX is looking at an estimated valuation of $1.8 trillion, debuting Friday with university endowments poised to strike, and a massive retail squeeze is totally expected. Then you have Anthropic, which filed paperwork with a $965 billion post-money valuation after just raising $65 billion in private funding. And OpenAI has confidentially filed at $852 billion, testing the market's appetite for pure-play AI labs as they aggressively aim for automated AI researchers by March 2028. This isn't just a list of cool new companies. This massive pipeline is going to severely test the broader market's ability to actually absorb all this liquidity, which could seriously dampen forward market returns.
But before you jump headfirst into this frenzy, let's take a look at the reality of the IPO gravity curve. Historically, the data offers a pretty stark warning for retail investors, mostly because gravity always wins. We typically see a day-one pop averaging about 15.2%, peaking around week 1. But then gravity sets in. Look at that red zone. That return structurally fades to just 3.5% by year 1. Take the Cerberus Systems case study on the bottom left. They surged 70% on their May 14th debut. 1 month later, the stock was sitting at roughly $238, which is down about 25% from its $311 first-day trading price. Because everyday retail investors are usually locked out of the initial institutional allocation, they often end up buying at the absolute peak and get left fully exposed to this massive 12-month structural fade.
Okay, part 4, sector dynamics and moats. Let's step away from the hype train for a moment and examine the actual structural advantages quietly operating in the market today. Let's compare how the titans are actually playing the AI game. Alphabet and Microsoft are taking an agentic approach, focusing on software that executes really complex tasks from simple commands. It's rapid innovation, sure, but it comes with sky-high cybersecurity and privacy anxieties. Apple, on the other hand, is taking an integrated approach. They're focusing on serving the user without ever compromising data. They're doing things like on-device cross-app data pulling. Imagine grabbing flight info from an email and putting it straight into a live phone call. Notice the text mentions at the bottom. Apple mentioned the word agent only 3 times in their presentation, but they hammered home privacy 21 times. The market reaction? Wall Street was totally underwhelmed. AAPL actually closed down 1.9% because investors just wanted those flashy agents, not quiet integration.
And this sets up a really fascinating comparison. We are constantly getting distracted by flashy hardware product cycles and shiny software updates. But what about the truly unassailable compounding cash engines? Things like DIY content moats.
While everyone is endlessly talking about Alphabet's AI agents, their true hidden cash engine is sitting right here, YouTube. The Midas Special Opportunities Fund, which has $27 million in assets under management, points to YouTube's millions of DIY videos as an unassailable moat with literally no viable competitor. It acts as this massive free cash flow engine with a wild compounding effect. Thanks to this, the Midas Fund, holding an incredibly low average cost basis of $9.56, consistently outperforms the S&P 500 on 3, 5, and 10-year timelines. This dynamic proves how excellent management, combined with non-cyclical video dominance, completely protects you against the volatility of short-term AI product cycles.
And if we step completely outside of tech for a minute, we see massive wealth creation happening in pharma with the GLP-1 weight loss wars. On the left, we have the pioneer, Novo Nordisk. Their flagship drug, Wegovy, reached 3 million U.S. prescriptions. That is literally one new prescription every 5 seconds. But Wall Street sentiment is mixed right now after a next-gen clinical trial failure sent Denmark's OMX25 index tumbling 3.6%. On the right, though, is Wall Street's current favorite, Eli Lilly. They aren't just relying on one blockbuster drug. They have form factor innovation with the Fundeo pill, incredible collateral benefits like sleep apnea improvements with retatrutide, and next-gen catalysts like the once-weekly aloralantide. Lilly's highly diversified portfolio positions it to absolutely dominate in the long term.
Let's look at another super quiet moat, this time over in retail. The perfect pricing flywheel relies on 4 very simple steps. First, you have to be the first to lower prices. Second, you use those incredibly low prices to drive massive foot traffic. Third, you use that high volume to heavily scale your efficiencies. And finally, you use the resulting value to lock in fierce customer loyalty. You want to see how this builds into an incredible business model? Look at Costco as our case study. Costco executes this flawlessly. They slash costs on private label Kirkland items and gas, which just drives foot traffic. Shoppers show up for the cheap gas and end up wandering inside the warehouse. That high volume creates total supply chain dominance, giving them the wiggle room to lower prices even further. The result? Membership renewal rates well above 90%. The performance metrics completely speak for themselves. Maycom sales rose 8.7%, and the average analyst price target is currently sitting at $1,105, well above current levels. It is a boring, predictable, and absolutely unstoppable cash engine.
Bringing us to our final section, Part 5, Macro Risks and Warnings.
Now let's bring it all back down to reality and check the actual macroeconomic foundation supporting this entire market. We have to address what's happening with global energy, which brings us to the geopolitical oil paradox. Recently, crude oil futures dropped 2.15% down to $89.34, basically based on claims of a final deal looming and a halt to Israel-Iran hostilities. But look just below the surface at what we call the structural hoard. Despite ceasefire hopes, global powers are quietly developing a hoarder mentality after facing 2 energy crises in just 4 years. They are actively building massive emergency crude oil reserves. So the reality here is that regardless of Middle East peace developments, this structural demand means energy prices could stay higher for a lot longer, continuing to heavily pressure inflation.
Before we look at our final chart, we absolutely need to define a critical technical term, the dead cat bounce. It's a temporary, short-lived recovery in declining stock prices. Put simply, even a dead cat will bounce if it falls from high enough. It creates this totally false sense of security right before the market takes a further, deeper structural drop.
Now, apply that definition directly to the S&P 500 cycle composite. The model indicates that the market has officially peaked and rolled over. We are entering a red zone where the technicals turn negative between now and late July, with a serious risk of lower prices extending all the way into October. And if you look at the market breadth widget on the bottom left, the warning signs are already flashing. Beneath the recent tech-led index gains, more stocks actually fell than rose, and it was all on reduced trading volume. This market is standing on very fragile narrow legs.
We're going to end with this really powerful quote from the briefing. The market's ability to simultaneously price in an unarticulated AI future and a highly uncertain Middle East peace deal shows peak bullish euphoria, leaving indices highly vulnerable to sudden technical reversals. We've seen the massive concentration risks, we've seen the consumer illusions, and the huge liquidity drain coming from those mega IPOs. While there are definitely incredible cash engines out there like YouTube and Costco, the broader market is pricing in absolute perfection in a world that is clearly imperfect. So I leave you with this to think about. As you navigate this crazy market, are you truly investing in unassailable moats, or have you simply bought into the illusion of a dead cat bounce? Thanks so much for joining me on this explainer, and definitely keep your eyes on the data.